So, fellow participants, colleagues, friends, good afternoon to you all. It's my pleasure really to be here, and I want to express my profound gratitude to the organizers and Charles Enoch in particular for inviting me to speak at this conference. What Charles might not have known when he invited me is the special connection between myself, my countrymen, and Oxford. Oxford happens to be the home of Roger Bannister, and we all know him, the first person to run the 4-minute mile. I was last here in Oxford in June of 2016 for another conference, and the high point of that visit was my tea with Roger Bannister and his wife. So I enjoyed that very much. So it was a no-brainer really for me to say yes. But as you know, he passed away last March. And so this visit brings to me many memories of that occasion and indeed of his life. So I want to thank the organizers as well for choosing a very relevant topic for our discussion today. In my remarks, I'll set out the highlights of some of the challenges that face all of us in the pursuit of leap forward in prosperity of our continent, Africa. At the outset, I need to apologize that I will shorten my address a bit to remarks, really, because I'm also fighting a cold, which I picked up in Washington, D.C. It's amazing how many flus come out of Washington, D.C. Last time there was a bad flu, it was called the global financial crisis. So this will only, maybe you could go as far as Oxford and nowhere else. And I want to start by outlining a few things which I call the opportunities that we see in Africa. In Africa, 58% of the population do not have electricity. Nearly 2/3 of Africa's population depend on agriculture. 60% of the population in sub-Saharan Africa and 37% of its workforce are youth under 25. 23% of the population in sub-Saharan Africa live on $2 to $5 per day. And yet another statistic, 47% of Africa's girls either do not complete high school or never attend at all. These, by any means, are dire numbers. And it may therefore appear surprising that I label them opportunities. But I want to emphasize, I see them as opportunities, and I'll explain why. I want to underscore that actually, against these bleak statistics, we've seen real change in particular areas. For instance, the macroeconomic environment has strengthened dramatically. For instance, inflation has declined. That's across Africa, has declined. Current account deficit. So against this sort of bleak background and numbers, we have seen some positive progress in particular areas. First, the macroeconomic environment has strengthened. For instance, inflation has declined across the continent. Current account deficits have contracted. Growth has strengthened, largely due to stronger policy frameworks, improving price of primary commodities such as oil, and also a very favorable external environment. That, I think, has been clear over the last 10 years. Actually, there has been remarkable progress. Another element would appear positively now in this light is that in 2007, Rwanda was ranked 137th in the World Bank's ease of doing business. That is with respect to the ease of registering properties. And in 2018, it was ranked 4th in the world. So that's a dramatic shift. A third element that is also positive a pointer, as it were. In Kenya, access to formal financial services increased from 26% in 2007 to 75% in 2016. Again, a remarkable leap forward. So you can see that there are three in these specific areas. Maybe 10 years ago, if we looked at the starting point, we would have said it's a hopeless case. It's a lost cause. 10 years later, we have significant improvement in each one of these. It calls to mind a famous statement by, among others, Mandela, who said, "It always appears impossible until it is done." And I think we can go back to the three, to what I call the opportunities a moment ago, and we could look at them in that same light and see that these really are challenges and the opportunities for us. And they appear impossible to us today, but they'll appear impossible until we get them done. So now I want to go back to these opportunities. These numbers, to me and to you, I want to convince you that they reveal huge gaps of what has to be, in my view, the greatest mispricing of all, the worst misallocation of resources. And I'll explain. We just mentioned that about half of African girls don't go to high school. They've never completed high school or have never gone to high school. So you could think of this as there's a huge need for education for girls. And actually the numbers for boys are a bit better, but not that much better. Girls obviously are the worst in this regard. Or you could think about electricity. We just talked about that. It means that there's a huge need for it. So huge demand for it. So somehow the private and social returns from investment in these areas, shouldn't they be huge as well? And if you think like everything else, you have a shortage of a particular output or particular item, you'd expect that the return on that, the marginal return on that is much, much higher. And then eventually you have diminishing returns and all those other things. So the question then is, why doesn't the financial sector price and allocate resources appropriately to these areas that I mentioned? That is really the core of my question. This question allows me now to discuss the issue that is foremost in my mind in discussing opportunities and challenges in Africa, which is the failure of the financial markets in their use of information. That is key. That is what I see as the core of the problem that is before us. I will touch on this and other examples and expand on them, clarifying, which I'm sure will be clarified later and expanded by others in the rest of the conference. The first issue, if you may, is what I would call a problem that relates to the size of the risk premium or risk premium if you consider different projects. It can be argued that, for instance, you think of the educating girls, or for that matter, in the electricity sector, putting up plants to generate electricity that is needed in a particular country and so forth. It could be argued that the risk premium for these projects are very large, that they are overwhelming or they overwhelm the positive returns for such investments. But this I'm not sure. Let's explore it a little. The question here is whether we have a good yardstick for risk premium, crucially, that is different from sentiment. So when you think about the risk premium that you assign to a particular investment in education, or for that education in Africa, or for that matter, electric generating plant in Africa, how do you assign the risk premium? How do you calculate the risk premium? And is it some sort of just, let's say, a random number that you have assigned because of your, I don't know, your sentiments in this way? I just came back from Washington. I came in from Washington, and last week we had the spring IMF World Bank meeting, and one of the questions that came up, or that kept coming up, was the impact of the impact on the emerging markets and other developing economies of the forthcoming normalization of monetary policy in advanced economies that we expect will happen and is happening. So the question was, what's the impact? And my answer when I was asked this question actually started by recognizing that in our markets, or rather our investments that are in Eurobonds, for instance, there is a very large risk premium that is assigned to our Eurobonds. So if you look at the yields, actually they are very large, and most of that is actually risk. Somehow they've beefed up, or they've padded our yield with risk. Of course, you cannot, as I said, it's difficult to explain how you've come up with that sort of number, the risk number, right? But it's there. And that's, in my view, the question that we need to look at. If we cannot, as practitioners, come to grips with or explain to anybody why is it that we have such a risk premium for a particular investment, it could be even Eurobonds, it could be even, we cannot explain to anybody how you have a particular risk premium on other projects, the ones that I mentioned a moment ago. By the way, yesterday, US Treasury, UST yields broke 3%, and for the first time in 4 years. And in Kenya, our benchmark, well, actually it's a 10-year bond, it is trading at 6.8%. And actually, this is from a peak of 7.2% in February. We have other 10-year bond that matures in 2024, which actually, when it was issued, was at 6.7. I'm skipping the little numbers at the end. 6.7% in June of 2014. It went up. The yield went up to 9.1% at end 2015, and it's now trading currently at 6%. So you can see swings of as much as 3% from already a substantial starting point of 6.7%. My point is, this is something that we need to understand better, and I'm sure that those that will come after me can discuss this and explain why we have such large risk premium, and what is it we need to do for the markets to correctly price risk. The concern could be risk, but it could also be the thin markets that we are trading in, right? So all these things need to be dealt with, and it isn't just the project that is a problem. So that is one thing that I wanted to bring on the table. But there's a related item which I think we should also be concerned about. Again, discussing risk, which is a few years ago when interest rates went low, in the markets, they came down dramatically, and there was a sort of excitement in Africa that we could even borrow Eurobonds, right? We could even issue Eurobonds. And one of the points that was, one of the reasons behind this, some people explained, is that actually to be good for the African countries to issue Eurobonds. Why? Because the pricing of these Eurobonds will serve as a disciplining effect on the African countries. So in as much as your bonds have been priced appropriately by the market, it will punish you, right? And you are getting correct information. The financial markets are getting correct information, data and all that, and they're using this to, in effect, punish the underperformers, and in fact reward the ones that are doing well. So we've come forward a few years, maybe 5, 6 years since then. But the point, though, is that it didn't work that way. Judging by the panic that was there in Washington last week, relating to the increase in a rapid buildup of debt in Africa and other countries, somehow we can say that that mechanism never worked. It could very well be that there was no data that were provided to the markets, but they should have asked for more data. I mean, so there's something wrong with the mechanism, and there's something wrong with the way the financial system is working, and consequently, we do have a real problem in the way the markets are pricing risk, and in particular for those investments those crucial investments I mentioned a moment ago. There's a corollary to this, and I will mention it and then move on, which is the issue of differentiating country risks and prospects. What appears to me is that at times all countries in Africa, or a bunch of countries in Africa, could be the West African countries, could be the East African countries, or the South African countries, are all, or that other part in the middle, whatever it is, I don't know what it is, the belt of Africa kind of thing. We are lumped into the same pool, and consequently, you could think of us, and therefore investors put money in our investments, and from their perspective, they don't distinguish Kenya from Uganda or from Tanzania. As a matter of fact, they probably don't distinguish Kenya from Ghana, because both of them are English-speaking countries. There is only one problem. They are several thousand miles apart, and they're completely different economic structure. One exports gold and cocoa. The other one has nothing to export except coffee and things like that, and tea. So the point about differentiating countries and doing the homework to make sure that we are not pulling several geographies together, but rather we are pricing the risk of each particular country is something that I think we need to think a bit more of, and also maybe discuss later in the conference. I want to move on to other things, which another big area that I would want to discuss. And this relates to a set of issues that relate to one of the bright spots in Africa, which is fintech and technology more generally, that have opened doors that were never before imagined. As was mentioned by Charles a moment ago, M-Pesa is now a complete ecosystem with P2P and P2B transfers, and it has really transformed many lives. We can discuss some of the specifics as to how that has transformed lives, but there are many stories. There's a lot of work that is going on to understand better how to even expand this phenomena in Africa and the rest of the world. But before we get into the specifics, I have a pet peeve that I have to deal with, right? And this is, I don't understand why the fintech gurus call themselves disruptors. I don't understand that. I think of disruption as sort of impeding forward progress, impeding forward motion or progress towards an objective. And as far as I know, when M-Pesa and other digital financial services were, when they came into being, they did challenge the brick and mortar model of banking that was prevalent then. But I didn't see them as disrupting banks in terms of banks' objectives and indeed customers' objectives. Unless, of course, the disruptors would have us believe that the bank's objectives was inherently anti-technology. So they are sort of Luddites. And therefore, they, from their perspective, they are disrupting the Luddites. So in a sense, I find that label somewhat villainizing the banks, something that I don't think I would agree. But anyway, that's probably neither here nor there. But that's one of my pet peeves, as I said a moment ago. But in terms of the substance, there has been progress that has been made, a lot of progress, as I mentioned, which has allowed banking services to do two particular things. First, to break the location and timing of transactions with the brick and mortar model. That's really what has happened. So you can actually make a transfer from the comfort of your own kitchen or the comfort of your own office. I mean, right here, I can make a transfer to my mother, right here from my bank or from through M-Pesa. Or I can actually buy, in a different setting, I can actually buy treasury bills of our government today and now from this room. So it has opened a whole new vehicle, but separating the location and timing of the transactions with the very rigid location and timing that is imposed by the brick and mortar model that we know in commercial banks. The other thing it has done is to reduce the minimum size of transfers. So you can actually now make, like I said, transfer a very little amount without going to the bank. I wouldn't go to the bank to make a transfer for, I don't know, 20 shillings or $20. But I can do that on the mobile digital financial mobile platform. I can do that. You can buy, as I said, for as little as $30 US. You can buy government securities. In the past, the minimum was something like $1,000 US. So you can see the minimum number or the threshold has come down dramatically. Those, in my mind, are the two fundamental things that have happened with M-Pesa and the other ecosystem. But from my perspective, that is only one thing that relates to the model as we know it in banking. And you may say that, or I want to argue that this really has only helped what I would call operational efficiency of banks. So the only thing that has happened to us in terms of the new digital financial services is to actually challenge and to push banks to be more operationally efficient. That is good, but that's not everything. And the rest of the talk, I'll cover some other areas where I think we are still lagging behind. And it relates to the use of information, which again is my principal point in this talk. So we have not seen, for instance, we've not made significant breakthroughs in allocating resources to greater returns. Remember, I mentioned a moment ago, there are various projects that could be there. For instance, think of SMEs, for instance, that have huge returns. I mean, not all SMEs have huge returns, but one can understand why some SMEs can have huge returns. Only that maybe the practitioner or the owner of the SME does not have the, let's say, the know-how to write a balance sheet, to put together a balance sheet or whatever other financial records in a particular way, and then sort of make an argument before a bank or whatever it is. So the example of SMEs, I think, is germane. And it requires the use of detailed information about the customer's transactions, about the customer's relations with others. Something that we have not quite begun to address. So for instance, in my transactions on M-Pesa, there's a record of all the transactions I did with all my counterparts, right? And if I was an SME, you can see when I'm getting paid, by who. That is in itself very valuable information. And today we have not had a good model that deals with that. If there is a $1,000 question, that is the $1,000 question. I would want a fintech that will come up and actually do justice to the information that is now available. Please don't sell it to Cambridge Analytica. Use it for the benefit of SMEs because it gives very good data that can be used in terms of lending, in terms of working without institution, and so forth. That then will allow us to make to provide resources to the area where there's the highest return. So in a sense, you begin addressing the allocational efficiency that I mentioned at the beginning. So providing resources to the returns, to the areas, investments where there's greatest return. So that's one area we need to do some work in. Then there's another area, also relating to information. And we have not made strides in intermediating savings. I'm talking of transforming short-term deposits into long-term loans. Of course, we have the example I gave you a moment ago, the one of M-Akiba, where you can buy securities and therefore you can see government securities, so you can see that as a new savings vehicle. And frankly, from our perspective, we believe that this will transform savings as we know it in Kenya, because you'll open a huge new vehicle for savings. It's available to people who are even in the $5 a day sort of wage. So you can see if you earn $5 a day, you can save $1 every day, and at the end of the month, you can buy $30 worth of treasury bills, which is your savings. By the way, I have to also tell you that it's not just a one-way street. It is also important that for you to have a liquid pool such that when the investor, in this case that person on $5 a day, when he needs to liquidate his or her savings, they can do it at a moment's notice, at any time, 24/7, basically. So there's also some work that needs to be done in the background, but that has also been figured out and it's available. In any event, the point we are making here is that this is just the start, and there has to be more work that goes towards this intermediation, improving the intermediation process as we know it. And this is what we would then call intermediation efficiency, an area that also requires a lot of information. And this, again, is something that we hope can be done for the benefit of our African countries. There's a third element, and again, also concerning information. In a regular brick and mortar bank, you build a relationship with it through your interaction, just like the drugstore or the pharmacy, as we call it here, or for that matter, airlines. You get into a relationship with your airline, they give you bonus miles or frequent flyer miles or whatever, but if you are dealing with an institution that is on your phone, and that institution could very well be a bank, or it could be backed by a bank, but your relationship is via you feel that from the perspective of the customer, there is something that is different, meaning the customer cannot distinguish whether this fintech is a Ponzi game or it's a real deal. You understand what I mean? It is difficult. I mean, just like when you call the customer service in some for some company, and there's a sort of a voice which sounds human, but you know it's not human. I mean, you want to talk to a human being. You know, if you are like me, I want a human being, and it happens that the human being is probably in Philippines for all you know, but it doesn't matter. That's a human being who is representing that institution. And the point for us is the same, that really for things relating to financial sector, there is what we may call a trust threshold. So a minimum level of trust that you need to engage with a particular institution. And you don't get a chance to build that trust with your favorite fintech. You get to build that trust with your brick and mortar bank when you go there and you meet the customer relations person and they offer you tea if you're okay and all those other things, and they ask you how the weather is, and I mean you're building a relationship with them. My point in all this is that the fintechs that we have been working with, they have been atrocious in building this relationship and actually ensuring that they meet the trust threshold that is necessary. The problem is that the trust, well, as we see it, the trust threshold, though a customer, the issue of trust comes to the fore, particularly when there is a problem. Or for that matter, the problem could be with the customer or could be with the institution itself. Quite often it's with the customer, and there's no sort of customer management system that makes sense to the customer. And so there's a substantial loss of trust, which, as you can imagine, can even, if you're thinking of a bank, if there's a substantial loss of trust, you could even end up having a bank run. By the way, bank runs nowadays are not necessarily, you don't have lines forming outside banks. You have people using their phones, and that's how the runs take place, you know. So a bank could go from being liquid to being completely out of money like this in a matter of hours, just because people are transacted quickly on their mobile phones and things like that. So I also know that the distributed ledger technology pundits obviously are claim that there is the prospect of a new world order, which will replace the trust as we know it with something else. Well, we can discuss that when we have the first use case of it. So I'll leave that for now. I should say that I think there's a lot of merit in the distributed ledger technologies, and we are looking forward to seeing, as a matter of fact, in Kenya, we are already looking at 4 specific applications. So we are working on that, but it's not as easy as some people claim it to be. So let's wait and we'll get there. Colleagues, I'll finish now. What I wanted to highlight and what I hope I've highlighted is what I consider the Achilles heel of our current financial system, which is the poor use of information that is provided to ourselves or we provide about ourselves. Obviously, the dire statistics that I mentioned before at the beginning will continue to challenge us and all other practitioners until the financial system can find ways to use information in the ways I explained above, addressing those key questions that I put forward. This is the task for each of us, particularly those in this conference. And I want to end with a quote from Sir Roger Bannister. However ordinary each of us may seem, we are all in some way special and can do things that are extraordinary, perhaps until then even thought impossible. Thanks for your attention.